ZIM Integrated Shipping Services is an Israeli container shipping company. It operates more than 100 different vessels for transporting cars and other goods. Recently, ZIM Integrated Shipping Services paid dividends of $2.85 per share for the first quarter of 2022, and the company is expected to pay out a total of $17.25 in dividends per share for fiscal 2022 and $7.04 for fiscal 2023, according to the sell-side's consensus financial projects obtained from S&P Capital IQ. The stock price is only $50, so the dividend yield is very high. When you see such a high dividend yield, it usually means that the market expects the yield will not last long. The shipping business is a cyclical industry. It has ups and downs. Container freight rates increased dramatically between January 2019 and May 2022. And the year 2021 saw an especially steep increase in global freight rates, reaching a record price of nearly $10,400 in September 2021. The shipping industry is very important to sustain a modern economy. Any minor changes in this sector lead to significant changes in the economies of individual countries and around the world. In 2020, the container market sunk significantly amid the pandemic, which led to a drop in demand in the consumer market. However, at the end of the year, the market began to recover, and since the beginning of 2021, it has been showing a record growth. An additional driver for the growth of freight rates was the boom in online sales. The existing imbalance in supply chains, the shortage of containers, as well as overload of large seaports. The market situation became very hard. Freight rates have risen sharply, predictability and reliability have fallen. The hike of freight rates and delays in ports have led to a change in logistic routes. Sometimes it's much more profitable to use rail transport if it's possible, or to carry out transportation using several modes of transport where previously only sea transport was used. Delays in ports have led to a change in the routes of many cargo flows. The principle the closer the port, the earlier the cargo is no longer relevant. An analysis of the market and the current situation in the direction of the cargo is necessary to approve the final route and choose the mode of transport. This is the biggest crisis of shipping industry in decades actually. It slows down the entire world economy, and of course the situation will start to normalize sooner or later. It is inevitable that freight rates will stabilize eventually and ZIM's earnings will decline. It might seem that all the most interesting things in the industry have already happened, and this year the companies of the sector have weak investing prospects, but if we take a closer look, it turns out that many of the factors that pushed freight rates up are still here. China continues its zero-tolerance policy, many key ports are still overloaded, ship traffic is behind schedule, and there is not enough capacity in the shipping market to meet demand. Clients prefer to lock in high shipping prices in long-term contracts to ensure supply stability. So most likely the situation will be stabilizing slower than it seems, and it is unlikely that we will see a significant correction in freight rates in 2022. In recent days, a new factor has been added: the threat of strikes by dock workers. Dock workers are on strike in Hamburg. Truck drivers' strikes continue in South Korea. This could lead to further difficulties in the functioning of supply chains. ZIM noted at the Bank of America Transportation Airlines Industrials Conference on May 19, 2022 that it is still taking a conservative view that the market might start to normalize towards the second half of the year and that the spot rates might cool off a little bit. The company expects revenue to decline by 31% in 2023 and 11% in 2024. Net profit will fall even more, so the current valuation ratios that seem to be extremely low will not be so low in the future, even though this stock is still pretty cheap. The company operates on a global scale across 5 geographic trade zones: Pacific, which makes up 33% of carried 20-foot equivalent units, across Suez 11%, Atlantic 18%, Intra-Asia 31%, and Latin America 6.5%. In the first quarter of 2022, the company carried 859,000 20-foot equivalent units at an average average freight rate of $3,848. And the balance sheet of the company looks pretty good now. Some other companies in the shipping industry look very attractive in terms of valuation ratios, some have fallen sharply in recent years, and some are beginning to adhere to the principle of green energy. For example, the world's largest shipping giant has ordered 8 vessels, each capable of carrying 16,000 standard 20-foot shipping containers from high and heavy industries. Unlike previous orders, the new vessels operate with zero carbon emissions. They will run on environmentally friendly methanol produced by combining environmentally friendly hydrogen and carbon dioxide obtained from renewable sources. It is assumed that the ships will begin to plow the world's oceans around 2024. The price is $175 million, which is about 10-15% higher than the average price of ships used by the company. And actually, the company was the first global carrier to decide to follow the recommendations from the International Maritime Organization. The IMO has set a goal to reduce emissions to 60% of 2008 levels by 2030 and to halve emissions by 2050. It's all good for humanity in general, but probably not for the company. The new ships are more expensive and the fuel for them is in short supply. Methanol is produced only by a few plants in the world. Their capacity is clearly not enough to ensure the implementation of IMO plans. So the competitors are not yet enthusiastic about the initiative and they don't hurry to support it. Some are betting on other alternative energy sources. For example, Asahi Tanker has ordered 2 fully lithium-ion battery-powered vessels. At the same time, there is no single alternative to traditional fuel in the sector. The use of other types seems to be economically inexpedient. This will raise the cost of transportation and put companies in not the most comfortable conditions if new fuel is problematic to buy. That's all for today and thank you for listening.